What's up everybody, I am Jasprit Singh and we are in an interesting time because the United States is facing an inflation crisis, we're facing a housing affordability crisis, and we're facing a supply chain crisis. And now with baby boomers getting older, we have an entire generation that's about to quit the workforce and move over to Florida, that way they can retire, which means we're about to face the worst retirement crisis yet. Baby boomers are the largest generation to retire yet, and they're also the least prepared to retire so far. I'm going to talk about what's causing this retirement crisis in just a second, but now the government wants to get involved because they don't want future generations, the Gen Xers, the Millennials, the Gen Zers, to face the same retirement crisis that baby boomers are facing. So you're going to see big changes coming to your 401k, and it's not just because you can use your 401k to potentially invest in crypto soon. We have some new bills that are proposed which will completely overhaul the way that the 401k is run throughout the country. Retirement planning back in the day used to be very simple because all you had to do was go to school. You don't even have to go to college, but you go to high school, then you go and get a job, you work there for 40 to 45 years, and then you retire. Now when you retire, you will get a pension from your job, you're going to get Social Security from the government, and then you also have what other cash and savings and investments you might have on your own. Now it doesn't really work like that. I mean, pensions are a thing of the past because they made absolutely no financial sense. The way a pension worked was you'd work for a company for 40 to 45 years, and then after you retire, the company will continue paying you, even though you're not working for the company, and they will continue to pay you until you die. Now, companies don't know how long you're going to live, and as people live longer and longer, pensions got more and more expensive, and they have to pay for somebody who's not even producing anything for the company anymore. Then when it comes to Social Security, Social Security is drying up. It's not what it used to be. This is where the Social Security lovers get very upset, and they say, no, that's not right. The government can just print more money and fund more Social Security checks so you don't have to worry about Social Security. The only problem with that is that the cost of living adjustment for Social Security, which is how much they raise Social Security by, is not able to keep up with inflation. Between 2021 and 2022, Social Security payments grew by 5.9%. It's called COLA, the cost of living adjustment. That's how much Social Security grew by. But at the same time, inflation has been about 8.5%. which means the price of things, the cost of living, has grown by 8.5%, and these are just the reported numbers. Many people are facing inflation significantly higher, but if we just stick with the reported numbers, inflation is 8.5%. Cost of living is growing by 8.5%, but your income is only growing by 5.9%. Now couple this with the fact that Social Security is running a loss. That means Social Security is spending more money than they're bringing in. So you Gen Xers and you Millennials, you're paying now for your own retirement from Social Security. That Social Security money that's being withdrawn from your paycheck every single day, that money isn't going to fund your retirement, it's going to fund the baby boomers' retirement because Social Security is running a loss. So this is where people say, oh, can't the government and the Fed just print more money and fund Social Security? And you're right, maybe they will. But what's going to happen? They will print more money to fund bigger Social Security checks, but then you're going to also have more inflation. When you print more money, that causes more inflation. So you send out bigger checks, you feel a little bit richer, and then you find out that your guacamole is even more expensive. So you'll never be able to print enough money through your Social Security checks to fight inflation, which means that if you're relying on Social Security, you're relying on a disaster. So now you have more and more baby boomers that are not going to get a pension, that are not going to be able to live off of Social Security, which leaves them with their own cash reserves and their own investments. Now, if you look at this in a bubble, that should make sense. Why would you want to rely on the government or somebody else to take care of you? It makes sense for you to be financially educated, make smart financial decisions from when you're young until you retire. That way you can retire on your own means and you can take care of yourself. But this is the situation that we're in, where a lot of baby boomers were hoping for other sources of income from retirement. And so here we are with a lot of pressure on that third leg, on that own cash and the own investments. Let me just give you some numbers, that way you can get a better understanding of why financially the government wants to overhaul the 401k system. If you follow the 4% rule, which means you withdraw 4% of the principal of your entire retirement fund every year, that's how much money you can live off of. If you take this 4% rule and now you apply it to somebody today, baby boomer, and let's assume that you only need $40,000 a year to retire. If $40,000 is 4% of your entire retirement fund, that means that you would need a retirement account worth $1 million to just follow this 4% rule. Now, hopefully, you can earn some interest or some cash flow from this $1 million to give you some more income. But if we just follow this 1% rule, assuming this $1 million is now growing, then you can live off of $40,000 a year. So you're not living a super lavish retirement, just a healthy, fair retirement. But you need $1 million to do that. This is at a bare minimum what you'd expect a baby boomer to have saved up or invested to help fund their retirement. But if you look a little bit deeper, what you see is that the typical baby boomer is worth $206,000. There's a big difference between $206,000 and $1 million. And when I first saw that, I assumed that the Business Insider report was wrong, so I did some more digging. And then I found a much more recent report, and that's when I found out that the average baby boomer has not $206,000 put aside for retirement, is that they have $202,000 put aside in their savings and investments for retirement. Well, that's not better news, that's worse news, so I kept digging. And then I found a Fidelity study where they found out that the average baby boomer doesn't have $206,000. They don't have $202,000 put aside. They have $138,900 put aside for retirement. At this point, I stopped digging because you get the idea. Baby boomers do not have enough money saved up for retirement, and if you follow the 4% rule and you assume that the average baby boomer has, say, $200,000 put aside for retirement, well, 4% of $200,000 is just $8,000 a year. In our economy today, it is going to be very difficult for anybody to live off of $8,000 a year, even if you live on a corn farm in Iowa. This is why the government wants to change the way that the 401k is done, because the government now wants people to be in charge of planning for their own retirement through their 401k instead of relying on a pension and instead of relying on Social Security, because maybe people are starting to realize that the government isn't the best entity to invest your money for you. The first major change that's coming to the 401k is actually not from the government itself, it's from what people want to invest in. We've seen a big movement of people wanting to invest their money in cryptocurrency and people who want to invest in things like Bitcoin and other cryptos for the long term through retirement vehicles. So you'll probably see the option to invest in cryptocurrency sometime in the future in your 401k, and some people will have that option probably later in 2022, where you'll be able to invest in Bitcoin and some other cryptos through your 401k. And in case you're wondering, but what about my IRA? Well, people have already been investing in Bitcoin and some other cryptocurrencies through their IRAs. That's not as difficult as the 401k. Now, I want to go over the government regulations that might be coming to your 401k, but before I do, I should mention this because we've seen an uptick in scams, especially in cryptocurrency. So if you are planning on investing your money in cryptocurrency, not through your 401k or IRA, but just in general, if you want to buy or sell cryptocurrency, make sure you're using a reputable brokerage. And if you're looking for one, you can check out our sponsor, FTX US. FTX US has a very simple interface that makes it super easy for you to buy and sell cryptocurrency. And the thing that I really like about it is they also make it super simple for you to dollar cost average cryptocurrency. So all you got to do is create an account, and then if you want to buy Bitcoin, you can enter in Bitcoin, and then you can pick a frequency. You can buy it once, you can buy it once a month, you can buy it once every 2 weeks, or you can buy it every day. If you're already buying cryptocurrency somewhere else, I recommend you check out FTX because the fees on FTX are so much cheaper than so many of the other major brokerages out there. So check it out, because now you can have more money going to buy crypto instead of having this money go to make your brokerage richer. You can buy and sell crypto right off of their app, you can buy and sell NFTs, and pretty soon they're going to be launching a feature which will also let you buy and sell stocks, equities right off of their app. And the best part of all is that our sponsor FTX US is rewarding you, our Minority Mindset fans, because if you use my link down in the description below and then you enter in the referral code MINORITY, then they will also give you a free coin when you trade $10 on their app. So if you want to learn more and start trading cryptocurrency and you want to see how you can get your free coin, all you got to do is click that link down in the description and enter in the referral code MINORITY. There are 5 main ways that this new bill wants to change the way that your 401k is run. What I'm going to do is I'm going to go over these 5 ways, and then I'm going to give you my thoughts on them because I definitely have some opinions about what they want to do. So the first thing that they want to do is they want to automatically enroll everybody into a 401k plan. So if you join a company and they offer a 401k, you don't have to opt in. You will automatically be opted in. You'll be forced to join the 401k at a 3% deduction, meaning 3% of your paycheck would automatically be deducted and invested into your 401k. Now, after you're automatically enrolled, you have the option to opt out or change your percentage, but you're automatically going to be opted in. So people on default will automatically be investing the money in the 401k, and then by default, you will also have your contribution increase every single year by 1% until you get to 10%. So over the next 7 years or so, you will start by contributing 3% of your income to your 401k plan, then 4%, then 5%, then 6%, all the way up to 10%. And then it will not go up any higher, but you will have the option to change this at any time you want, but that will be the new default if this plan gets passed. The second thing that the government wants to do is, if you're a little bit older, if you're between the ages of 62 and 64, they want to increase your catch-up contribution. Right now, I think it's like $6,500 extra that you can put into your 401k if you're older, but what they want to do is raise that to $10,000 in this catch-up phase, but they have a catch. Now, if you do this catch-up contribution, invest this extra money into your 401k, you will not have the option to invest it typically, which is where you pay taxes on the back end. The government wants their taxes now. Big surprise. Meaning, if you fall into this category, you're 62 to 64, and you want to invest this extra money into your 401k, you would have to pay taxes on this money today, kind of like how it would be if you were investing your money into a Roth 401k. Third, this one is really interesting. If you have student loans and you make a student loan payment, it would be treated like a 401k investment. Now what that means is your money that's going towards your student loans isn't going to go into your 401k, but your employer has to match it if they offer some sort of company match. So hypothetically, let's assume that your company offers a 50% match. So if you invest $1,000 into your 401k, your company will match that by 50%, so they will invest another $500 on your behalf. So now, if you have student loans and you can't invest in your 401k because you don't have that extra money, and so you take $1,000, use it to pay off your student loans, what this says is then the company would have to treat that like a 401k investment, and now they would have to match that to 50%, so the $500 would go into your 401k. So you have $0 in 401k from your own investment because $1,000 went to your student loans, but the company would have to treat that investment into your student loans, which, if you want to call it an investment, we'll just call it an investment for this case. The employer would then have to match that with whatever percentage they have and put that money into your 401k. Fourth, the government wants to change the mandatory withdrawal date, which means that right now, if you have a 401k, when you turn 72, you're required to start pulling money out of your 401k. Now, that might seem kind of weird. Why are you required to pull money out of your 401k if you don't want to? And it's because of, well, taxes. The government wants to make sure that they get their fair share of taxes, because when you pull your money out of the 401k, you're going to have to pay taxes on this money. And if you did not have to pull your money out of the 401k and you died, well, then this money would then go to your heirs, and they get something called stepped up basis, which essentially means that if you have $1 million of profit sitting in your 401k and then you die and your kids get that money, well, your kids could sell this $1 million worth of profit and they wouldn't have to pay any money in taxes, because now that $1 million worth of profit is now their basis. Their basis is not what you bought the stocks at, their basis is what the stocks were worth when you died, or your investments when you died. So your kids get stepped up basis, and the government doesn't want that because they want their fair share of taxes, so they require you to pull your money out of your 401k. But what this bill says, because now people are living longer, is you would no longer be required to pull your money out of your 401k when you're 72. Now you can wait until you're 75. And fifth, this proposal says that if you are a part-time worker working at least 10 hours a week, or if you're an independent contractor or a freelancer, you will be required to be able to contribute to your company's 401k plan if they have one, because right now, if you're an independent contractor or if you're a part-time worker, chances are you don't have that opportunity. But through this bill, you would be required to have that opportunity, assuming that the company has a 401k plan. Now, I obviously have my own personal opinions about a 401k. I'm not a huge fan of the 401k. That's why I don't have a 401k and I don't offer a 401k currently to our employees, because I feel like there's a lot better ways for you to invest your money, for you to get better returns, and for you to get actually better tax breaks with more control over your money when you're financially educated. But the 401k is a great way for most people to start investing their money. It should not be your sole retirement plan. Even the founder of the 401k has come out and said that the 401k was never intended to be your sole retirement plan. You should be investing your money yourself, so I want to make sure I start with that. Your 401k is a great way for the average person to invest their money, but it should not be the only way that you invest your money. Now, if you like a 401k, fine. Invest your money in the 401k, but now let's talk about these things. You have to understand that, first off, your retirement planning isn't going to become cheaper because you're automatically now going to have a 401k plan, because the government never said that they're now going to reduce the amount of money that you have to pay towards Social Security because you have this 401k plan. but now it will be in addition to your Social Security payments. So the Social Security payments that you have will stay there. Maybe they will even work to increase the Social Security cost sometime in the future because Social Security is running dry. I don't know what they're going to do with that. So your Social Security costs are not going down, but now they're saying that you have to increase the amount of money that you're investing in your 401k. Now, I'll tell you from an employer perspective that compensation for an employee is more than just salary. You look at the salary, you look at the healthcare costs, you look at the retirement plan costs. All these things are bundled up together in compensation. And so if an employer is required to give more money to an employee, in this case through a 401k plan or whatever it might be, well, that's going to ultimately affect the total compensation, and then you will be affected in different ways. Like if an employer is required to give out more 401k matches, well, then what that means is now they're compensating you more, and that might mean that your future raise might be a little bit less to make up for this added compensation. Now, the whole idea here is that this is going to do more good than harm if people are automatically investing their money in their 401k. And the reality is, yes, this will do some good, but it also comes with its own fair share of harm. Now, I would love the idea of everybody automatically investing their money. But when you're forced to invest your money through one particular investment vehicle, what does that mean? Well, you kind of get trapped. For one, this is great news for money managers on Wall Street, because now these money managers on Wall Street that take a percentage of every dollar that you invest in your 401k, because yes, your 401k has fees, and if you don't know what your 401k fees are, that means that you're the one that's probably paying the higher fees. So every 401k has fees, every fund that you invest in has fees, which means that you should go look into your 401k plan and see what type of funds that you're invested in. But now money managers are hearing this saying, oh my God, this is great news. Everybody would be required to invest their money into these particular funds, because it's not like you have a full spectrum of options. I mean, maybe if you have a company that's giving you dozens of different options, but if you don't and you only have a few funds, well, now your money managers have you locked in, because now they're going to have you invest your money from the age of 21 until 65 years old, and they're guaranteed to take a percentage of your money every single year. So this becomes a big windfall for the money managers on Wall Street. Now again, everything has its pros and cons. I would much rather you invest your money in a 401k than just save this cash or just spend this money at Gucci. I mean, if a money manager is going to take a little bit of money, but at least you have a retirement fund, hey, that's great news. But what you have to also understand is you don't want people to become complacent when it comes to investing your money, because now what you don't want is people to say, oh, my 401k is growing, I'm increasing how much money I'm putting in there, so I don't have to do anything else because my 401k will take care of me. I wish there was some sort of element of financial education, financial awareness, investing education, so people understood, okay, I'm going to put 3 to 10% of my income into my 401k, but that's not all. I'm also going to invest my own money. That way I can continue to build my financial future and build my wealth, so I don't have to hit a point in my future where I don't know what's going on with my money. And the last thing that I want to say about this is when you don't have any sort of financial education, no sort of financial awareness, what ends up happening is when you have a stock market crash and people open up the 401k portfolio and they see that the 401k has been cut in half, guess who is the first one to sell their 401k portfolio and then realize all these losses? Well, it's the people that are not financially educated. We saw this happen in 2020. We saw this happen in 2008, where people lost such a big chunk of their retirement savings because they panicked and they sold and they didn't understand what their 401k was for. It's a long-term investment plan. If you're not planning on retiring for 20 or 30 years, why are you selling your 401k at a massive loss? Second, when it comes to this catch-up, I really don't have many opinions on this. I just think it's funny how the government is going to force you to pay your taxes today on this money because they're letting you invest more money in their 401k. The government wants their taxes. What can you say? Third, when it comes to student loans, if now employers are going to be compensating employees more because you're investing money, you're paying off your student loans. It's so weird for me to say investing money to pay off your student loans, but if you're paying off your student loans and the employer is going to pay you for that, well, again, it goes back to the whole compensation thing. That's great for you right now, but there's a chance that you could see a potentially smaller raise in the future, or potentially smaller salaries, or something else cut to compensate for that added cost, right? At the end of the day, compensation is salary, it's 401k, it's all these other things. And don't forget, let me just mention this right here, that your Social Security cost that you're paying every single time you get paid, some of it is paid by you, and the other half is also paid by your employer. So if you didn't have that big of a Social Security cost, if let's just say Social Security costs were cut in half, then you could just say, hey boss, instead of giving this money to the government and Social Security, how about you just give it to me? There's no change in compensation, but now you're making more money. Unfortunately, you don't have the ability to do that right now, but just know that your Social Security fees are costing you just over 12% of your income every single year. Now, you might be thinking, but I'm only paying 6.2%. Well, that's because you pay 6.2% and your employer pays 6.2%. So 12.4% of your compensation is automatically being invested by the government, but the government's admitting that it's not a good investment because your Social Security investment hasn't been able to grow enough to fund everybody else. So they want you to now do this, and they want to cover it through these methods discussed right here. But it might be a little bit easier if instead of having you forcefully invest your money into Social Security, you could just invest that money yourself. But of course, that would be a very difficult thing to do because now you have so many people relying on Social Security, even though the Social Security fund is drying up. Fourth, when it comes to this mandatory withdrawal, this is another reason why wealthy people hate the 401k, because why are you forced to sell your investments? What if the market is at a loss and now you're forced to sell your money at a time where you don't want to? This is again another real tax hindrance when it comes to the 401k versus another investment. You're not forced to sell if you're not using one of these government-sponsored retirement plans. You can sell whenever you want, or if you don't sell, then you can pass it along to your heirs and then they get the stepped up basis, so you have the other benefits there. So this is just one of the perks, or I guess difficulties with the 401k. And then we have this last part when it comes to part-time workers. Now I think it's really nice that they open up the opportunity for part-time workers, independent contractors, and freelancers to be able to invest in a 401k. I think that's great. But the difficulty would be then, again, is what about that match? Because that's an additional cost for the employer. So depending on what the requirements are there, because if they're just giving you the opportunity to invest in a 401k, that's one thing. But then if the employer is required to match the investment that a part-time worker or a freelancer or an independent contractor makes, well, that's an additional cost to the employer. So there's still a bit of uncertainty of how this one is actually going to play out. Let me say this one more time. I personally am not a fan of the 401k, but for the average person, the 401k is a great way for you to start investing. It should not be your sole investment vehicle, but it's a great way for the average person to start investing their money. Now, if you have more money going into your 401k, then sure, it is good. But again, having this money being invested without any sort of financial education is also dangerous, because now you will be the first person to sell your 401k when things start to go down, and we will see more volatility in the coming decades because we have a lot of issues in our economy that we have to deal with. So, it's good to get people to invest their money. I 100% agree. But it would be even better if we had some financial education to go with it. And the last thing that I want to say when it comes to retirement is I have my own opinions about retirement, because I talk about how typical retirement is stupid. And I think a lot of younger people, a lot of millennials, and definitely Gen Zers are definitely starting to understand this. And you're starting to see this now after the pandemic as well, because people are starting to realize that it doesn't make sense for you to work from the age of 21 until 65 or 67 and nowadays 70 and then quit and then start living your life. It doesn't make sense to hold it off until then. If there's a way for you to start living your life sooner, where you can blend your work and your lifestyle together, that way you can start living happier and do something that you love when you're younger, this is what people are looking for. They're looking for this type of lifestyle design where you can start living your life, do something that you care about, and fund your lifestyle all at the same time. And it starts with that sort of financial education. And now, because of this pandemic, people are able to work from home. It's also having a job that aligns with your values, that aligns with the things that you like to do. Those who retire early die early. And the reason is when you have nothing to do and you sit at home and all you do is just start watching TV all day and night long, when you're used to working 8 to 10 hours a day, you will go miserable. You need to have a purpose in your life. You need to have a reason to get up every single day. And if you love what you do, you're not going to be working to ultimately quit so you can just sit on your butt all day and watch TV. You need to have a purpose in your life. I talk about my quadruped theory, where you need to be physically fit, mentally fit, spiritually fit, and financially fit. Physically fit means, if you're on your deathbed, you're morbidly obese, it doesn't matter how much money you have. Mentally fit means you need to care about your mental health. If you're miserable, if you're anxious, if you're depressed, it doesn't matter if you have $10 million in the bank. More money is just going to make you more miserable. But then you got to be spiritually fit. This doesn't mean religious. This means what's your purpose? Why are you getting up every single day? What's your reason for being here? You have to start finding your purpose, and you need to figure out what it is that you care about, how you want to change the world, because once you have these three things, that's when being financially fit has the biggest impact. If you enjoyed this video, here's a video on President Biden's new tax proposal that I think you'll love. Thank you for watching, and as always, keep hustling. The United States is facing a lot of issues, from inflation to this growing national debt and this national deficit, and in order to combat that, President Biden wants to raise taxes.